welcome, welcome. Welcome to this session. Welcome. Thanks to those who are able to join, and thanks to those who are supporting the Champions League wherever they are. The recording for this will be available so people will be able to watch it over time. And hopefully some others are able to join us as we go along. But we're going to start now. And I just want to say thank you to all those who have been able to join so far. And Perpetual, thank you so much for joining. So for those who don't know, Perpetual Okejimi helps individuals and business owners build, protect, and secure their financial future through smart insurance and financial solutions. And with over 13 years of experience in the insurance industry, she has guided hundreds of families and entrepreneurs in making confident financial decisions through effective insurance, wealth building, and long-term financial planning strategies. So today we're going to be having conversations with Perpetual on insurance, everything about it. And if you have questions, please pop them in the comments and we will bring them up as we go along. But this is a very free flow, friendly conversation. We're here to learn from someone who is an expert in this. So, Perpetual, thank you once again for joining us. And you have the floor. But be ready, I've got questions.
Yeah, I trust you, Temi. I know you like to ask questions, so we are here for you. Good evening, everybody. I'll greet again. First and foremost, I want to thank God for this opportunity, and I want to thank Temi, Coach Temi. I call her Coach Temi because she's coaching us on how to plan our money. It's not just insurance. She has been showing us. It has been a series of training, and it's been amazing. So thank you for this opportunity. So Perpetual, I've worked with ICO for over 13 years, and I've helped individuals, I've helped business owners to plan their finances using insurance and other investment options. So today we are going to talk insurance. We are just going to have this conversation. We are not going to speak plenty insurance grammar. We are going to make it simple so that we'll understand what we're talking about. So I'll ask a question. Have you experienced this, or do you know anybody that once had a very good life, was earning very well, living the beautiful life? Their children were going to the best schools in town, living the amazing life, living the good life. Then life happened. The person died, and the children now started running around, running from pillar to post. Does anyone know anyone in that category?
I know
Have you met
stories.
anybody in that?
I think
Okay.
everyone knows somebody.
True. Everyone knows
Yeah,
someone in that category. And the truth is, that situation is avoidable. It's totally avoidable, it's totally preventable. And how can you prevent that from happening? A simple insurance plan will prevent that from happening. Because most people see insurance as, what is insurance? What they keep talking of insurance. People see insurance as an extra expense. No, it is not. Insurance is protection. Insurance is helping you to protect what you have. Insurance is helping you to guarantee that, okay, so what I say, it guarantees that you don't fall below a certain level. You have put your family on a certain level, you are living, your children are living the good life, your family is on that certain level, then make sure they don't go below that standard. And how do you do that? You use insurance to achieve that. I always say, if you are worth 100 million, you should have an insurance that is worth 100 million. If you are worth 1 billion, have an insurance that is worth 1 billion, so that if anything happens to you, your family does not go below that standard you have set for them. So it reminds me of someone, this lady, a typical example. She was living, her parents, her father was doing very well. Her father had a great job, was living the life, was doing so well. Then this man died from nowhere. And when he died, the children were even, they started begging for food. It got so bad, they started begging and scavenging. So we don't want our children to be in that situation. We don't want our families to be in that situation. That is why an insurance plan is needed. That is why an insurance plan is not even it's not negotiable, it's not something you say, okay, should I not? It is a must have. Once you
mm,
start making money, once you start earning, once you start having dependents, you should have an insurance plan by yourself. Because yes, in the modules you talked about group life and all. That's for the organization. Do it for yourself. Do it by
yeah.
yourself. The one you have control over. So that when the needs arise, your family is able to access what you have. Your family does
So
not have to depend on you. organization. Your
Yeah.
family does not have to depend on anybody. So insurance is something that everybody should have. And
So
we have
thanks. You
different types.
actually brought up the course, and we have a few participants here who have actually followed the module on that.
Okay.
And we know that there are different kinds of insurance.
Okay.
So can you tell us about the different kinds? So I think you've spoken about life insurance protecting your family. Is
Mhm.
that the core focus of insurance, or is there more to it?
Okay, so I missed out introducing Toyosi. Toyosi is here.
Okay.
Because of that said, I did not introduce her. Okay, so Toyosi is here from ICO as well, and
Okay.
she's the lead non-life sales support.
Okay.
She's the lead non-life sales support. So she's here with me. We are going to have
So
this conversation
so what
together.
I'm hearing is we have life and non-life
Yes, we
insurance.
have
That's it,
non-life.
right?
Yeah. So those are the two basic categories. So the life insurance is everything that has to do with a human being.
Mm-hmm.
The group life, the endowment, the retirement plan, the annuities, the children education, they are all in the category of life.
Life,
The
right.
yes. So the non-life, your house, your car, your vessels, everything that is non-life is in the
Okay.
category of non-life. So that's the two broad category.
Yes.
So there can
Okay.
be subcategories, but that's the two broad categories.
Okay, so thank you, Toyosi, for joining us, and we look forward to hearing from you. I would just like to direct bit. So we have the live and non-live. Now, for those
Yeah.
who are not clear, what we're trying to achieve here is we have the Money Simplified course, and one of the key topics we talk about is insurance. You can plan everything, you can do everything right, and then one situation in life destroys everything. Like Perpetual mentioned, everybody knows somebody. Even if it's a distant somebody, you know somebody, even if it's that uncle on your streets that used to live down the road that died 10 years ago, and now nobody knows where his family are. It's things like this that bring the importance of insurance. So, what is insurance, Perpetual? What is insurance itself?
Insurance in its simple terms is protection. Insurance is you're telling an insurance company that, see, I have all these things. I need you to help me protect these things because I can't do it on my own. Yes, we are not God, and we don't promise that things will not go wrong. But help me take care of this thing so that in case this thing happens, I don't have
Mm,
to start from ground zero. Help me protect so that if anything happens, I'm still able to bounce back as if nothing has happened. So insurance is protection,
okay.
protecting everything you have.
You have. So we've heard a lot. I mean, we've all heard the word insurance, and you've clearly said it's protecting what we have. Now let's make it practical. So I I have come to you, ma'am. You have been shouting insurances. What is it that I'm protecting? Yeah, tell me. What do you want me to protect? I'm protecting what I have. What am I protecting? What kinds of insurance do you have? And what does each of them benefit me? How does each of them benefit me?
Okay, so thank you for your question. The truth is, one, we don't give, so insurance is specific based on individual needs.
Thank you.
So you come to me now as a woman, so I'll ask you some questions.
Mhm.
Because some of the questions I ask you will direct me on the plan to advise you on. So we take the plan based on your needs,
Okay.
on the scale of preference, which is more important to you. So I'll ask you, Temi, are you married?
Yes, ma'am.
Temi,
Sorry,
are you?
people, if you want to add your own question to this, please kindly put it in the comment section. But for now, I'm the one getting interviewed. Let me know what insurance I need. Yes, I am
Yes,
married.
yeah. Yeah, so do you have children?
I have two children.
Oh, good. So, are you employed? Are you a business person or you're
I am
employed?
both, my sister. I work, I get a salary, and
Yeah.
I also earn a living from my
Yeah,
other
so
job.
we need to make
Yeah.
the money. So multiple streams of income. Okay, so
Yes.
I'll ask you, um, on a scale of preference, what is most important to you now? Your children's education, your investments, or your retirement plan?
Hmm. So we have Toyosi's hands up. Toyosi, do you want to say something
You want to say
before
something to your
I
see?
answer my question? Or was that a mistake? Okay.
No, it's actually not a mistake. Okay, I actually wanted to add something to what Perpetua was saying initially, right? And
Mm.
I'm sorry to cut you short, Perpetua. You still take up
It's
That's
fine.
which you're saying. So don't forget. I like the line with which you're towing, right? So you asked a question. You said that what is insurance, right? And naturally, I just like to put it in three simple words. It's just your financial protection net. Now, insurance is not to make you rich. I know that right now, everybody wants money. You want an ROI of 35%. You don't mind the high risk, high returns. That is not what insurance is. If
Mm.
you are on the fast lane, don't think insurance. I will always advise, because if you're on the fast lane and someone one way or the other gets you to buy insurance, you might end up getting frustrated.
Yep. And I'll
Yes,
give
True.
an example.
I want
True.
us to tell ourselves the truth. Don't, if you are not thinking protection, if you are not thinking unforeseen circumstances, please don't think insurance. I think that will just be my opening message. Then I'll just allow Perpetual to take on. Then, if I have any other thing to add, I'll come on board.
Thank you so much for that. And that
Thank you,
is
Temi.
important. In all that we're going to talk about today, note that insurance is not an investment. Yes, you may put some money into insurance that will give you, it can have an element of investment to it where you would get returns, but it is not the investment that you're going to use to build wealth. It is the funds that you're going to use to protect the wealth that you're building. So it is a protection. Because let's face it, so let me give a good example. Imagine that you are doing well, you're healthy, and because you know that, what, I'm a 25-year-old young lady, in my mind, I'm still 25, going to the gym every day, doing all of these, I'm very healthy, nothing do me. And then you don't have health insurance, but you have like maybe
Money.
20 million in your investment, doing fantastically well. And then you fall down one day, oh, there is something wrong with you. You go to the hospital and they're running tests, and each test costs, today they're calling 300,000, tomorrow they're calling 1 million. Before you know it, all that 20 million you thought you had saved is gone. And you're now borrowing to continue treatments. Meanwhile, if you had had health insurance, you would just have paid, depending on the package you got, 100, 200, 400,000 a year for premium, and your insurance company will cover at least maybe 60 to 80% of that cost, depending on what they are doing. Insurance in this case is just protecting that wealth you're building so that you're not using everything to take care of your health because you have already put in some protection. Perpetual, am I telling the story well?
Yeah, true. Yeah, you're on point.
Yeah, let's
Yes,
go
you are.
back to my interview. Please tell me.
Yeah, yeah. So yeah, thank you Toyosi for that contribution, and thank you, Temi. So I was saying, so I asked you back to where we stopped
I'm
on the
married, I have
scale of,
two
yeah,
children.
yeah. So on the scale of preference, what is most important to you now? Your children's education, your protection plan, or your retirement plan?
When you say my protection plan, what do you mean?
So your endowment, so do you want to grow your money with insurance? Do you want to grow your money with an insurance plan, or you just want to keep enjoying your money? What is most important to you
So
now?
for me, I can invest my money. Investments are not my
Okay.
problem. I have
Okay.
investments, and I have an investment that will take care of my children's education. So I have a plan
Okay.
for that. Now,
Okay.
obviously, that investment has, I'm saving it gradually. I have a plan to save in that pool for another 12 years now to reach the
Okay.
target, right? So my concern and why I'm speaking to you is, God forbid, nothing's going to happen to me. But if anything does happen within between now and that 12 years, I wouldn't have put enough money in that investment for my children's education. So I know that there is a risk in that space, right? There is a
Okay.
certain exposure there. I also, but in terms of investing itself, I'm happy to keep investing I mean, I know that insurance is not going to give me crazy returns. In fact, the last time I checked, I think a friend of mine was making about 6% a year on her investments, insurance related investments. So obviously, I'm not doing that, but I do want some form of protection.
Okay. So you want something, if I hear you clearly, You want a plan that will protect your children's education.
Yes.
You're doing something for them in an investment platform elsewhere, but you
I'm
want
investing
something
for
that,
them using,
yes,
I have a fund where I'm investing for them for their
yeah.
education. I have my
Mm,
personal investments for my retirement. Obviously, I have my pension fund as well. So I think
yeah.
everything is going well according to plan. However, I
Okay.
do have the concern that should anything happen between now and when those purses are filled with the funds I want them to have, I would need some kind of protection. And that's why I'm speaking to you now. What kind of insurance do you have? Look, I've heard of life insurance. I know that life insurance is not going to give me anything if I don't use it, right? I've heard of life insurance. I've heard there's a child endowment fund. Can you help me understand what all these things mean and how I can practicalize them for myself to make a decision?
Okay, so just like you said, based on your concerns, you want something that will protect your children's education between now, okay, for like a 12-year period. In case anything happens to you, you want to be sure that your children get the kind of education you want for them.
Yes.
So what I would recommend to you is a school fees plan.
Okay.
Yeah, so what that plan does for you, you have a plan that guarantees that your children get the kind of education you want for them. Whether the parent is there or not, you already tell the insurance company, see, I want my children to school in Harvard, I want my children to school in private universities. I don't have that fund now. Hopefully in 12 years I'll be able to accumulate it. But if anything happens, you want the company to take over the education of your children. So we'll
So,
structure a plan for you.
okay.
Okay.
So
Yeah, you're
what
going
I'm
to say
hearing
something.
is there is a plan that I can create with you. And
Yeah,
in this plan, I will tell you how I want it to run if it ever is needed. So I'm putting money into the plan, and
yeah.
then I can give you instructions. Should I need to utilize this plan? I want it to be strictly for their school fees. Would you pay directly to the school?
Yeah, so it is actually called a school fees plan.
Okay.
So you have the option of paying directly to the school
Okay.
or you pay to the parents. So it's the instruction you give us will follow. So some parents say, no, I want this money to be paid to the school. So I want my child to school in Harvard. And when it's time, be paying to the school for the duration of the course. So you
Okay.
sign up a plan with us and we pay for the whole time, whether the
Okay.
parent is there or not. You have that option, or you have the option of cashing out at the maturity of the plan. You get
Okay.
the money back by yourself and use it the way you want to use it. So we have
Okay.
that plan in place. Yeah.
And this is the school fees plan.
Yes, it's the school fees
What are the
plan.
features?
So the school fees plan, like I said, it guarantees that your children go to the kind of school that you want them to go to. So the features of the benefit, let me list the benefits.
Okay.
This plan helps you get, so I keep repeating that because that's the major benefit of that plan. So another thing that plan does for you, it gives you a cover in case of death.
Okay.
If the parent dies, the children get the school fees paid on the behalf of the parent. So for instance, the parent pays for 1 year, there's the option of paying one annually or a single deposit. So for
So a
instance, the
lump
parent
sum
chooses,
once.
yeah, the lump sum deposit, yes.
Okay.
So for instance, the parent chooses the annual premium plan. He pays for 1 year and death occurs. The plan does not end. Yes, we don't expect any premium from him anymore because he's obviously no more alive. But at maturity, if you have told us to pay for the children's school fees, at maturity, the child's school fees is paid to the school as he requested.
Okay.
For the remaining duration of the plan, no more premium comes in. That's one. And two, if the child gets a maintenance fee. So
Okay.
because the parent has taken that plan, the child is paid a maintenance fee for the duration. So for instance, you take a 12-year plan and death occurs at the second year. So we put into consideration knowing that this child does not have a parent to care for him anymore, or maybe there's another parent existing but does not have the means to take care of the family. So we pay a maintenance fee to the child till maturity. And at maturity, he's able to cash out and get the benefits for his school fees. Then there's a rider, additional riders, in case of critical illnesses and disabilities. So for instance, you take up this plan and disability occurs along the line, the parent is protected. We will not say because you're no more able to pay this premium that you're not covered anymore. We'll just deal with you and still do the premium as if, run the plan as if you're still paying the premium. So this plan is beneficial, is very good for school. Any parent that has children in school should have a school fees plan because it
Okay, so
protects.
let me ask some questions because I would like
Okay.
us to, what I want from here is not theory. I want us to practically be able to understand how this would work.
Okay, fine.
So I want my children to go to Harvard. It's going to
Okay.
cost me about $50,000 a year for 4 years. That's $200,000. That's a lot of
Yeah.
money.
Mm-hmm.
So first off, let's just for ease, let's assume we're talking 1,000 naira exchange rate. That's 200 million. Now, my
Okay.
children are, let's say my child is 4.
Okay.
University is going to start in, let's say 13 years, right?
About 13
Yes.
years.
So I need 200 million to be available in 13 years. What exactly would I need to do? I would need to pay a premium, right?
Yeah.
So, guys, a premium is basically the money you pay to the insurance company every year to ensure that your insurance is still valid. If you stop paying your premium, your plan could go bust. And
No premium, no
Perpetua, you can
cover.
explain how that links to, because I know for life insurance, if you stop paying the premium, depending on the kind of plan you take, if you stop paying the premium, then it means that you no longer have an active protection. For the school fees plan, if you stop paying the premium, I'm not talking of when you die, if you die. I'm saying you are alive, you're working, you don't have anything, and you just decide, guys, look, I cannot pay you this money this year. I don't want to. Is there any implication?
Oh, okay. So let me get it clearly. If I heard you clearly, you start up this plan this year.
So let's say I
You
start
pay
up the plan this year, and then in year 2, I realize that I don't want to do it anymore. Or
you
I
don't
don't
want
have the
to do
money to
anymore.
pay.
Okay.
Or I don't have the
So
money to pay.
okay, you don't have, okay, so there are different things. So for this plan, for an endowment plan, this is an endowment plan. If you start up the plan, you can pay the plan for the first year, second year. If you decide that you don't want to pay anymore, maybe you are not able to pay because of unavailability of funds, after
Mhm.
2 years, you can decide that you end the plan.
Okay.
You end the plan and you get your money back.
Okay, good.
However, if you pay for just 1 year, the plan is just there because without premium, there's no cover. So
Yeah,
you need to pay your premium to get the cover. You need to pay premium to get the protection you want.
good. So let's assume I continue paying my premium. I'm a good person. Okay. Now,
Okay.
what kind of premium would I be paying? So I need 200 million, 13 years. 13 years is when my child will start going to school, university. And this is for university, it's not for secondary school. So what would I expect? Do you have a way to calculate now and let me know what my premium would likely be?
Okay, let me see. Let me see if I can access. So I'm not sure I can access it, but so we'll calculate it based on your
There'll be
age.
factors you would consider.
Yeah, so we'll consider
Okay.
your age and the
Mhm.
duration to get a premium.
Okay, good.
So I can't give an exact
No,
figure
that's
of what you
okay.
pay. Yeah,
Ballpark based on the fact that I'm in my late 30s, I'm female, I am working, I still have like 20 years to work.
okay.
Ballpark based on your experience, what kind of amount would you expect my premium to be for 200 million in 13 years?
Okay, for 200 million in 20, in 12,
13
13
years.
years.
Yes, yeah.
For a children's school fees plan.
Guys, this is not
Maybe,
actual math,
yeah.
so don't
So
take
no,
this
so
and
we
run
are
away
just
with
this
it.
is
This
just
is
just
for
an
this is for
estimate
our
because
example. Yes, please.
yes,
This
it's
is for
just
our
an example
example.
and it
Disclaimer.
varies from individual to individual.
Yeah. Oh, I
There's
know.
no one size fits all, so
Mm.
it depends on your age. So for a 30-something-year-old person, female, you'll be paying about, let's say,
18M. Okay.
18 to 20 million annually.
All right. So let's say
However,
it's
if you
18.
okay.
Let's say it's
If you
18.
decide
Go on, please. Go on.
However, you may decide to do it single deposit. So I always recommend single deposits because it ends up being cheaper. If you're able to accumulate the funds and just pay it at once, you end up paying like 40% cheaper than if you decide to do it annually. So
Yeah.
I just needed to say that by the way. But
Mm.
of course, if you want to do it annually, that option is there and it's fine. So
Okay.
I needed to mention that.
So let's say it's 18 million every year. So I have
Okay.
13 years and I'm paying 18 million every year.
Yeah.
Now, God forbid, this person, not me, has paid 36 million after 2 years and the person
Okay.
then dies. Or the
Okay.
person is disabled and can no longer work. And you've said there is a cover. So I'm assuming it's the same kind of life cover. It's the same kind of cover that will cover if the person dies. So
Yeah.
in a school fees plan is an insurance plan. And the reason I'm harping on this is if you go to a money market fund and invest your money and you're targeting saving towards 200 million over 13 years, the day you stop putting money in it, that's the end. You don't get any cover anymore. So if you only put for 2 years and you had 36 million and something happens to you, um, there is no guarantee that that 200 million will be reached because nobody's putting money into that investment. But Perpetua, what I'm understanding from what you said is this 36 million is what I have been able, the person has been able to put, and then the person died
Yeah.
after 2 years. You will still assume, because the person has died, the life insurance then kicks in. And it is
Yeah.
assumed that they have met the principal of 200 million, right?
Yeah.
Which
So,
means that
so
in 11 years, when the child is ready to start going to school, their school fees will be paid as planned.
yeah. Okay, so that's the beauty of insurance. Like Teo still mentioned, insurance is totally different from your regular investment. Insurance is protection. I keep saying
Yeah.
that because we don't pray to die. We will not die, we will all live long. So for a parent that takes up this plan and dies at the second year, the beauty of this plan is the first thing that happens is the plan is, of course, you're no more able to pay your premium. So like you explained, the regular investment, the family gets what you have put in. What you put in is what you get out. But in insurance, once the person dies, and the insurance company is notified, first and foremost, the child gets a maintenance fee, like I mentioned. So
So
for
in
the
this
next,
our scenario, what kind of maintenance fee can the child expect to get?
it's about 12%. 12%.
12% a year.
Yes, yes, annually.
Okay.
12% annually. For the
Sorry,
next 10,
12% of the
12%
200 or 12% of the 36?
of the deposit. Of
Okay,
the
so of the
deposit.
36.
So
Okay.
for the next 11 years, that child gets paid every year. Then at maturity, the child still gets paid 200 million. So this is a benefit to the family. So the
Okay.
family benefits the maintenance fee, then they cover.
Okay. So in summary, your school fees plan for the parents here, school fees plan is a great plan when thinking about caring for your children's education. Now, we also have life insurance. How does that contrast from school fees plan?
Okay, so if you're talking life insurance, so if you're talking life insurance, school fees plan is also a life insurance.
Okay.
Yes, it's
So
life
what about the
insurance.
one that does not have any? So the one I'm asking for now. So maybe you can
Is
help us
the term
break it down.
assurance. So
Is
maybe
what?
so we have the term assurance. The term assurance is pure. That one there's no investment, there's no interest, there's nothing at all. It's
Okay.
purely debt. It's purely debt. So because we know that Nigerians, we don't want to, nobody wants to die. So that's why we bring in these policies that have a bit of returns when you survive. So for a pure debt plan, that's a term assurance, it's purely debt benefits. If the person survives the policy, nothing comes to him.
Okay.
If he doesn't survive it, of course, the family will be paid the benefits. However, we have another type of term assurance. So because the same factor of Nigerians wanted to get at least, I'm alive, I want to get my money. So we also came with money back, what they call it, money wise. We call it money wise insurance. So it's a modification of term assurance
Okay, tell
in
us
the
about
sense
it,
that
please.
so in this, the way that works is you pay your premium just like the term assurance. If death occurs, your family gets back the benefits. However, if death does not occur, you get a part of your premium. There's no interest, you just get your premium back.
Okay, so it's kind of, since you did not use it, let's give you back some of the
Since
money you
yes,
paid.
just take back
Okay.
your money. We are not taking your money. And since death did not occur, you have something to go back home with. So that's term assurance. That's purely life assurance and protection.
Okay. So what other kind of life insurance do we have before we call to your CEO?
Okay, so we have endowment plan. So the school fees plan is an endowment plan. So
Okay.
endowment plan, like we explained, it gives you a bit of interest because we know that Nigerians like to have their monies. Nigerians don't just want to put money down in insurance. They want to have money when they survive their policies. Then there's a plan. Yes, well, you said you want to treat it as a pension plan, but it's also an insurance plan because anybody that is self-employed, anybody that does business, anybody that pays himself, that does not get regular income should have an annuity plan. That plan is an annuity plan.
Okay.
An annuity plan for you, if you work in an organization, you mentioned you have a pension plan in your organization. But
Mm-hmm.
for a business person, they don't have a pension plan. Is they just make money, they invest, they put their money garbage in, garbage out. And they are going to stop business at some point. They are going to stop being very active. So I always recommend an annuity plan for anybody that does not have a pension plan anyway. An annuity plan gives you the opportunity to say, okay, this is what you want to earn, and this is the year I want to start to earn my pension. So
Okay.
an annuity plan pays you for as long as you live. It doesn't stop, it just keeps paying you. You are sure that you're getting regular income. So an annuity plan is recommended for anybody that is self-employed, anybody that wants to have a regular stream of income,
Mm.
even in old age or in retirement. So
Okay.
those are the plans I would like to talk about here.
So for an annuity plan, we can touch on that for a minute. For an annuity plan, you have, even if you are self-employed, you can get a pension of your own because there are tax benefits to having a pension. But
Mhm,
with the pension, you do not get that money until you either are 50 or you're retired, right? And even so,
mhm.
sorry, even if you're retired, you have to be at least 50 to
50
get
years, yeah.
access to that money. So if you retire at 35 and say, oh, I am doing financial independence retirement, retire early. If you retire at 40, nothing for you from your pension until you're 50. That's the minimum age to withdraw on it. But if you have, even when you retire and you finally get your pension, there is a 25% lump sum that you get, and then the
Mhm.
remaining 75 can be put back into your PFA to give you monthly earnings. That 25% can also be put in an annuity, which means that you have two institutions that have your money, and the annuity is paying you for life, you said, right? And I would want to understand a bit more about that in a minute. The annuity is paying you for life. Your PFA is also paying you for as long as it can, which means that you have two places where you're earning retirement income from. I'm correct, right, Perpetual?
Let me take it from there. The truth is, you got it at retirement when you're 50 and you retire. You get 25% paid to you as a lump sum. You can use that 25% to buy an annuity plan. The
Mm.
interesting part is the remaining 75%, you can also decide that you want an annuity plan with it.
And you take it out from your PFA and put it in an
Yes,
insurance
there's that
company.
option. That's what a lot of people are doing now because annuity pays for life. Program withdrawal is what your PFA does. PFA, your program withdrawal cannot pay you for life. It pays you for how as long as the money lasts.
Mm.
So, but your annuity pays for life. So, what a lot of people do now is okay, at retirement, they take their 25%, they move their lump sum to annuity. So, they are sure that they are earning for as long as they live. So, for instance, someone that is earning 1 million,
Okay.
for example, or 5 million monthly, then at retirement, you do a program withdrawal. Okay, at retirement, you get 25%. And you know that at retirement, your income will definitely reduce. If you're earning 5 million as you're working actively, at retirement, your income from your PFA will be like maybe 2.5 or 3 million.
Yeah.
So, and if you want to increase that, you now say, okay, I want to do my personal annuity. You do that, and you do your PF, you move your money to ICO, to in an insurance company as well, and do. So I needed to call ICO, yeah. So you move it to ICO, and ICO will pay you for as long as you live. So you have this. So maybe you want to say, okay, I'll be earning 5 million. I don't want to go below 5 million. So you
Okay.
balance it so that your annuity, your program, your annuity, personal annuity, and your income regulated annuity pays you for 5 million. It makes it up to 5 million. So we
Okay.
call that income regulated annuity.
So if I come to you for an annuity, I want to do an annuity now. I will tell you how much minimum I want to earn, and then you will tell me what my lump sum payment will need to be to meet that requirement, right?
Yes. You
Okay.
tell us what you want to earn, and that will
You
let
then
us
do
know
the
what you will.
computation. Okay.
Yeah.
Thank you. So there are
Then
different
sorry.
kinds. Go on, please go on.
Okay, so you mentioned the age. So for personal annuity, we have immediate and we have deferred. For
Okay.
immediate annuity, you can start to earn from 35 years old. So unlike the your PF, your pension, you don't need to wait till 50 years. If you have the lump sum, you can start your annuity from 35 years old. And because some people say, I don't want to wait till old age. Let me start eating this money because old age is fast. So they start their annuity and they start getting paid from 35 years old for as long as they live. But I just needed to mention that.
Okay, thanks. So these are the life insurance. Health insurance, that is under non-life, right?
Well, okay. Health insurance is also, it's in between. It's life. You
Okay.
can call it life. You can call it
Okay.
life. So,
So guys, there is life and there is non-life. Now, the life insurance is basically some of the stuff we tend to avoid. In fact, for those of us that are scared of thinking about that because we think the moment we think it will happen, we probably avoid thinking of life, right? But this is where your child education plan comes in. This is where you have the money that you set aside in insurance that hopefully would help your family be able to cope and continue even when you're not there. This is where we now have the pure life assurance as well. So even if you say, my children are all graduates, they are not going to school, so I don't need a school fees plan. It's always a nice idea for them, for you to leave a legacy for them, which is where the life insurance comes in. Now, Perpetual, before I let you go and we bring Josephine on, I'd just like to know, is there an age limit at which point I can no longer get life insurance?
okay. Yeah. The maximum age for life insurance is 65 years old.
So once I'm 65, I
Once
can
you
no
are
longer
65, you cannot pay premiums.
buy.
It's only annuity plan that you can pay till you're 75, 80. All other life assurance plans and terminate at 65 years.
So if I get so there's pure, do you have a difference between pure life and whole life? Do you have that in ICO?
Yeah, so in NICO, we used to have, we have whole life,
Okay.
but for now it's on hold
Okay.
because, so whole life is supposed to last for life. So it's on hold for now. We don't do that. It's only annuity that pays for
That
life for
does that.
now.
Okay.
So
So
it's
you
only
have
annuity that
term
pays for
life,
life.
which means that even if I come to buy life insurance and I say I want term life and I want to, you choose the number of years you want your life insurance to be for, right?
Yeah.
So if I come to you now and I say, oh, I'm 40, I want to get a life insurance and I want to get a term life for maybe for the next 30 years. I'm assuming you will tell me the maximum you can give me is 25 because I'm
Yes.
40
You
and it
must,
ends
all
at
premiums must
65.
pay at 65 years.
Okay.
So
All
because we are
right.
looking at most people retire at 60, so we don't want to burden anybody to keep paying premiums and
Yeah,
after
but
retirement.
if I want to keep having the insurance so that whenever I die, in whatever this thing decade, my family will still get something. Are you saying that I stop paying the premium at 65, but the insurance remains?
No, it stops at 65 years.
Exactly. So what you're saying is I can't, if I'm not paying anything, I'm 60 already, I'm not thinking of children education or school fees plan or any such thing. Once I'm 65, there's no chance for me to do any form of insurance that can give my children an inheritance, even if I'm 90 when I pass. Yeah.
An annuity plan does that.
And
Annuity has
annuity.
the death benefit, yeah. They give
Okay.
death benefit in annuity, yes.
And there's
And
no, I read somewhere, I heard somewhere that there was a 10-year window. After you collect it, once you withdraw for 10 years, the death benefit expires. Is that correct?
no. So for immediate annuity, you take up, so the immediate annuity, you start it at 35 years. So
Mm-hmm.
after 10 years, so we call it 10 years guaranteed period. What that means, the simple explanation of guaranteed period is within 10 years, you're able to finish your money. Let me put it in simple terms. So for instance,
Yes.
you put in a particular amount, that amount finishes within 10 years. So that's why we call it guaranteed period. But however, after life, after 10 years, you still get paid. And for immediate annuity, after, even if it's after 10 years, your beneficiary gets 5 times annual benefits.
That's if the person dies.
Yes, anytime the person dies,
So someone
beneficiary gets,
starts taking their annuity, immediate annuity. Immediate annuity is the one that you pay for now and you start using it now, right?
immediately from
Good.
35 years, yeah.
So we'll come back to the deferred one. So someone starts at, let's say the person starts at 60. The person is not trying to start young. The person takes their annuity at 60 and starts collecting monthly at 60. At 75, which is 15 years after they started utilizing it, the person
Mhm.
dies. Will the family still get something?
5 times annual benefit. So for
Okay.
instance, you are
So
getting
basically
five
5 years
years,
worth of benefits.
Yeah, 5 million annually. So times 5, that's what the
Okay.
beneficiaries get.
Okay. Now,
Hello.
this is
Sorry.
irrespective. This is irrespective of. So even if it's 20 years later, sorry, Perpetual, are you still there? Okay. So if this is 20 years later, the family still gets something, yes?
Yes.
Okay, good.
Anytime death
Anytime.
occurs, family
Now,
get it. And
you
that's
you
okay. So that is what is obtainable now. So policies change yearly.
yes, we know.
So for now, that is what is obtainable. So
Okay.
5 times
So
annual benefit.
what about the deferred one? How is that different from the immediate?
So the deferred annuity, you don't have the lump sum. So immediate annuity, you have the lump sum and you want to start to earn immediately.
Okay.
So for the deferred annuity, you don't have the lump sum and you cannot. And so you don't have the lump sum and you say, okay, I want to accumulate the funds for the next 10, 20, 30 years so that I can accumulate the funds. Then after accumulation, then we start paying you for as
Okay.
long as you need. So that's the difference. So you use time to accumulate. You don't have the lump sum. And
So
you
what
don't
if
know
the
you cannot
person dies 5 years into accumulating?
of course the beneficiary gets the money back.
Okay, so they just get the money they accumulated. They
With the
don't get
interest at the
extras.
market interest at market rates.
Okay, okay, good. Now, let's come back to something you said. I have now, I'm 39 now. I have a lump sum. I want to buy an annuity, but I don't want to start collecting on it till I'm 50, which means that I want to put it aside, but I don't want to actually start using it until another 11 years. Is that possible?
Possible, yes.
Okay,
People
so
do that
what
as
is
well.
what is unique about how does that work?
Yeah, so you say so normally personally I don't really like this option because if you have the lump sum, just start enjoy your money because some people will say, okay, people in that category, they put the lump sum down and they say, I don't want to earn my money, just leave it there. And when they turn 50 or 60, they start to get paid. But I advise people that come to me with that request, collect your money, start earning, and you can invest as you're paying you invest your money instead of just lumping it because the difference in earning is not really much. If you
I
have the
see.
lump
So
sum, yes,
it doesn't increase the amount I have as lump sum and give me the opportunity to earn more returns
it doesn't,
when
the
I start.
difference is not much,
Okay.
except you don't have, if you have the lump sum, start earning.
Okay. Okay.
Yeah.
That's great. Thank you so much, Perpetual. Um, so do
I
we
think
have Toyosi
Madam
with us
Josephine
now?
has somebody has a question, I think.
Oh, okay. So the
Or
hand is
somebody has,
down. I think it was Josephine who put her hand up. Josephine, do you still have a question?
Yeah, so I
Okay, go
actually
ahead.
have two questions. The first one is just to reconfirm. So someone who is less than 35 and wants to start to earn from annuity cannot until the person turns 35. Because we have some people at 28, they have enough money, they want to have an annuity as an extra income. So they can't earn until they turn 35. Perpetua, please confirm that. Then the second one, I think you now answered it later on. The deferred annuity, my understanding was that it could also be a situation where someone puts down a lump sum and says, okay, let it be here. I don't want to start collecting now. Maybe 10 years, 5 years down the line, I start earning it. But you have confirmed that it's not really advantageous. So you don't recommend that. Am I
yeah,
correct?
yes.
Yeah. Then the other one I wanted, you were talking about 5 times annual something for the beneficiary of an annuitant. So what does that really mean?
Okay, so thank you for your questions. The first one, for the immediate annuity, you have to be 35 years. So we have some people that make money before they are 35. So those are the ones that we recommend deferred annuity for. That have people that have lump sum before they are 35, we can now recommend, okay, defer it till you are 50, or you wait till you are 35. If you want to start earning immediately, you cannot earn immediately until you are 35. That's for immediate annuity. So for anyone that has that kind of lump sum, we can recommend other plans to just defer until you are 35, then you start an annuity plan.
Okay.
Does that answer your question?
Yes, it does. It does. It answers the first question.
Okay, so for the death benefit, 5 times annual benefit. So for immediate annuity, if you have a deferred or immediate annuity and death occurs, so for instance, you started this plan and you start getting paid monthly and death now happens, your beneficiary gets 5 times your annual benefit. So for instance, ICO is paying you 5 million every year and death occurs, your beneficiary gets 5 times 5, that's 25 million. Are you there?
Interesting. Yeah,
Yeah.
I'm here. Okay, thanks for clarifying. Thank you.
Okay, thank you.
Thank you, Josephine, for that question. Thanks, Perpetual. So, Toyosi, are you with us? Is Arsenal causing high blood pressure with those penalties?
So the penalty is giving me.
The penalty, yeah, yeah.
Mm,
But yes,
okay.
don't worry, there's hope. There's hope.
There
Fear
is
of
hope,
missed
eh?
one soon. Okay, so let's talk about the non-life insurance now. And I would like us to start with health insurance, please. So can you tell us the different non-life insurances available and just give us some details about them, and then we can ask practical questions as we go along.
Okay. Thank you for having me here. I'll start by trying to put how will I put it now things into perspective. There are two types of insurance, right? Like you said at the beginning, there is life insurance, which we call the insurance of benefit, and there is non-life insurance, which we call the insurance of this English has escaped my head now. Okay, let me put it this way. The insurance that guarantees you to put you back to the position you were before the loss occurs, right?
Okay.
Now, in life insurance guarantees you payout at death or maturity, right? Death, unforeseen circumstances, critical illness, and all, permanent disability, and or maturity. Maturity is you get paid at the end of the tenure that you have actually fixed for the policy, right?
Okay.
Now, when we talk about non-life insurance, it's an insurance of indemnity where it puts you back into the position you were before a loss occurred. So in
So you don't get
non-life,
money back.
you don't get money back except there is a loss.
Okay.
Okay. And now nobody plans for loss to occur, but they occur, right? So that's where non-life, which is the insurance of properties, things that are tangible, things that have value, things you can put a price on, things you have receipt for, right? I
Mm.
have a receipt for my TV. I may not have receipt for my house, but I have receipts for all the building materials. I have receipts for what it cost me. I can put an estimate to it. You cannot put an estimate to your life. You can only say, okay, this is what I'm worth, quote and unquote.
Yeah.
So when we talk about the insurance of non-life, we are talking about the insurance of motor, we are talking about the insurance of houses, we are talking about the insurance of money. Money. You insure money in non-life, whereby we call it fidelity guarantee. You can insure your staffs against fraud, against infidelity. They can actually swindle you, take your money away. Yes, you can insure that under non-life. You can insure your property. You are not the owner of the house. You are not the owner of the container, but you are the owner of the content.
Okay. So
Your
that's content
content, you have
insurance.
insured. Yes, your content, you have insurable interest on it. You can do that. You can insure your gadgets, which is all risk, but we don't do it as a sole insurance, right? You must actually be insuring it with other things. Now, this is excluding phones. Now, when I say excluding phones, in isolation. Okay, some people buy I what's it called now, iPhone 17. No, I want to insure my iPhone 17. We don't do that in ICO. I mean, not know about other competitors. It's possible they offer that, but I have an office. I have computers. I have photocopying machines. I have printers. I have all that, all those gadgets, right? They
Mm.
can be insured. under all risk, right? I
Okay.
have a generator. You can insure your generator under plant all risk. My generator can decide to pack up and not work. It's going to affect my business, all those things. As long as we have what we call business interruption insurance, I run a club. My club gets burnt. On a normal day, I make like 15 million every weekend. And I have business interruption insurance for about 2, 3, 4 weekends. I am not making money because I'm trying to put my club back. Insurance pays you that money that you have actually indicated at the beginning. So these are the things that we have under non-life insurance. Things you can put a value to, things you can put an amount to. Indemnity will restore you back to the place you were before the loss occurred. Thank you very much. And that will be for now.
Okay, thank you. So, where does health insurance fall in here?
Okay, I usually advise that if you want your health, I want to cry, PSG don't win.
I know. You can't see my face. Mm.
Hi. Okay, back to business. Father Lord. I usually advise people that when you are insuring things that are of economic value to you, you don't just do, how will I put it now, a sprinkle of it. Okay. So when it comes to your core health insurance, I usually advise people for to go to HMO, approach the HMOs, which is a different arm, quote and unquote, of insurance. We are from the same father but different mother, something like that. Okay.
Mm,
So HMO will give you, maybe I'm going for the standard plan, I'm going for the executive plan. They will tell you, oh, okay, um, you have your dentist visit covered once in a year, you have your ENT covered once in a year, you have regular, you understand, you have your antenatal, prenatal, natal, whatever covered. Then you have what's it called? Your child's immunization and all that covered up to 1 year. They give you all those things in different forms and sizes, depending on your paying capacity.
yeah.
You can pick whichever suits you. And that is why we always advise people when somebody comes to you and the person is trying to force down insurance on your down your throat, please run. Insurance has gone beyond, oh God, I have this package. It is very nice. Yes, all insurance packages
You
are
will get
nice.
tax break.
Yes, all insurance are good, but we do insurance these days as if you are visiting your medical doctor. We sit you down, we run a diagnosis before we make prescription. I can decide to give you, how will I put it now? I can decide to give you, quote and unquote, now a flexible endowment plan. Meanwhile, what you need is not that, but maybe something else, maybe an annuity plan,
Mm,
like Perpetua said. You are still young, you're trying to save up, and I'm telling you that you should come and buy school fees plan. For which child? You understand? So I usually advise that if you need, we have a bit and pieces of health plan that can actually give stipend, right, in case of injury, but it is not as fantastic as you will get from HMO,
mm.
right? Insurance will just only give you a piecemeal
Okay.
of it. So that's just my.
Okay, so let's go back to the other insurances you've mentioned. Please, if you have any questions, this is a good time to bring it up. But just to summarize here, I have I'm going to give some practical examples. I have a group I'm on, and a few weeks ago, someone's business had the premises where she conducts her business caught fire, and everything was
Okay.
burnt. And we were all asked to do some form of contribution to help her out. Now,
Okay.
let's assume she had life insurance. Sorry, so let's assume she had business insurance. You mentioned business insurance. You also mentioned content insurance. What kind of insurance basically would you advise this person to get? Someone who has a
Okay,
business.
yeah, for
He sells
somebody who has
things,
a
by the way.
business, you have a business, you have what's it called, a premises to yourself. Fire insurance is what you need to get. Now, when we talk about fire insurance does not necessarily mean your house is on fire.
Okay.
Fire covers explosions. It covers tornado. We might say, oh, we don't have that in Africa. We don't have that in Nigeria. Yes. Earthquakes. We've seen landslides in some parts of Nigeria. We've seen flood. Flood is under fire. It's covered under fire. Flood can actually pull down your fence. It can pull down your building. That's where insurance steps in. That fire insurance. You can be pumping water. It is so funny. What's it called? Overflowing of water tanks. You can pump water. Probably your tank does not have the floating switch. What floating switch does for you is that when your water goes low to a particular level, it starts pumping your water automatically. When it gets to a level in the tank, it stops pumping. Now you don't have that. You were pumping water, NEPA struck. You forgot. You went to work. Before you got back, they brought back water, or probably you closed the business for the weekend. Now your tank kept pumping and pumping and pumping and pumping. Maybe until your unit finishes, will it stop pumping? And it pumps for you all through the weekend. And by the time you came back, your office is flooded with that water. You have your furniture soaked, you have your equipment, your what's it called, printers and everything. Fire covers that. So for that person, then the business interruption that I said is also under fire insurance. You get a fire insurance for your business, not only because of the physical properties, but for some of the unforeseen circumstances that you might encounter in running your day-to-day activity. Okay, so business interruption comes under fire. Burglary comes under fire. Okay,
Mm.
if my office doesn't get burnt, but it gets burgled, there's an evidence of forcible entry or exit. They broke down my locks and keys. You understand? Anything can happen. So that's where all these things come into play. And for that person, that is what we advise that the person do.
So the person gets a fire cover and it also covers them for their content, whether it is from fire or from natural disaster or even man-made
Yes,
natural like disaster or burglary.
yes.
Okay. And then if you're a homeowner, when you get a homeowner's insurance, it covers you for all these things as well, right?
On your content,
No,
not to the
homeowner.
building.
Homeowner, if you
Okay,
get,
you are
yes.
yes, yes, yes,
So if
yes,
the
yes.
building burns down, he
You are
gets
covered.
covered. Okay. Now, there's something I've heard called betterment. Can you tell us about that?
Okay. This woman knows insurance. So. Perpetua, you would have told me, let me read books before coming. So when we talk about betterment,
I've done insurance for a bit for my company.
oh, okay.
She
When we
knows
talk about
insurance, yeah.
when we talk about betterment, it's usually applicable when there's an auto claim, a
Okay.
claim in motor insurance. Now, I will put it in a scenario. Okay,
Mm.
I I I batched my car. Okay, and probably it affected only my fender, my bone, and my bumper. Okay, my front bumper. Now we changed the bumper. Probably your mechanic, they will always tell you Tokumbo is better than new. Tokumbo is better than new. Your car is silver. They now went to get you a yellow bumper that is Tokumbo. Will you be carrying, will you be carrying the yellow
I'm
bumper?
actually seeing a yellow bumper with silver.
Ah, you can see that I'm in the spirit. Okay, so instead of your car needs to be back in the place you were before the loss occurred, right?
Yeah.
Now, what this means is that there is every possibility that once they paint that bumper alone, the shade of your car might be different.
Mm.
You now say, okay, since you have painted only the bumper, now why not paint the fender? And probably you are now the one suggesting so that it can blend. Now, don't forget that the affected part of your crash
Was the bumper.
was the bumper. Now you are asking us to take it a step further. We will take it a step further, but we will charge you betterment. Now, what is betterment? Betterment is a percentage that you will pay out of that extra mile you are asking us to go to.
Mm.
Okay? We are actually supposed to replace your bumper and paint it. But you are now saying that paint fender, paint the full car. So instead of paying 70,000, for example, to paint your bumper, your panel beater is now asking us to pay 150. We can charge you, okay, maybe 20% betterment of the 150, which will be about 30K, and the company gives you 120,000 to go and paint your car.
Mm. Okay.
Yeah,
Josephine,
that's
please,
what's happening.
please go ahead.
Madam Jocelyn,
Madam
can you hear
Josephine.
her?
Oh, thank you. I was looking forward to unmute.
Okay.
Yeah, so thank you so much, Toyosi, for this presentation on the fire insurance. So I happen to have one with your company for
Okay,
my event center business, the building and the content. But I
okay,
find
ma'am.
this one you mentioned very interesting, business interruption. Petra, you can even chip in here too. I don't know if my insurance, my current fire insurance also takes care of interruption. What I'm thinking about here is mostly with generator. Event and generator, they are five and
Mhm.
six.
5 and 6,
So
yes.
it would be so nice to know if what I have currently is going to, if it covers that. For example, the generator suddenly packs up and something needs to happen. And if it does not, does an opportunity exist to add it on? So that would be my two-in-one question here.
Yeah, and maybe you
Thank
can
you.
just tell us a bit more about what business interruption, how it differs from the just fire policy.
Okay, okay. Like I said earlier, I think Perpetua will
Yeah. So
probably
let me
revert.
mention, yeah,
Hold
your
on, she will revert to you behind the scene
okay,
about what your policy covers or not. But in the
okay.
meantime, I will advise if she checks and they are not there, you can actually request that you want a business interruption added and a plant all risk. I want to believe that whoever the underwriter that did your transaction must
Mm,
have placed that generator under a plant all risk, okay? So that whatever risk that happens to your generator is covered. So if that is not there, you can make a request for it and an endorsement will be done. An endorsement is when you make changes to your
To the
current,
add-on.
what's it called?
coverage.
Your current contract in
Okay.
insurance, okay? Then they will just do the calculation of the extra premium you're going to pay and you're on track.
Anyway,
So
that's
that's
the bit I don't want to. So you people should not charge me
how you
extra
will pay
premium.
money. You will pay money, event business. There's money in
So,
event business.
Petra,
Pay
did you
money,
want
pay money, pay
to
money.
give me any information? But this is
Yeah,
definitely something I'm interested in if
yes,
it's
ma'am. So
not there.
Perpetua can reach
Mm.
out to you to confirm
Okay.
what your
Yes, so
current
we'll talk
coverage
about it
is.
outside this
Yes.
Okay. Okay. Great. Thank you so much.
But
Yeah.
sorry, Toyosi, could you just
And before
go on?
and before you go on, there's something that came to my mind when she was talking. We as individuals, we are busy, we are generals in our field. Please don't be too busy to fill your insurance proposal form yourself. You are the one that knows where the shoe pinches. Take that proposal form and go through it. See, on every proposal form, Everything there means something. Apart from your name, date of birth, address, and NIN number, every other thing on it, you can ask questions. Sit with your financial advisor. Insurance means it goes a long way. Like we always say in Africa, God forbid there is a claim and you are not the one that filled your form. Your financial advisor might just feel, okay, maybe you want basic or something. Always ensure that you sit with whoever is offering you any of these packages and ask questions. Ask that, okay, what if we go this way? What if we go this way? It's not going to hurt. 20 minutes, 30 minutes of your time can save all of us a lifetime testimony whereby they will not say insurance is, you know what
It's,
they call us,
insurance is a problem. Mm.
is a
Let's
scam.
let's use that. Okay, so I wanted just to go back a bit on this business interruption. How does it differ from fire? Can you just help shed a clear light to that?
How does it differ from
Fire.
the business interruption?
Yes, please.
You wake up every day to make money. Something happens to that source of income, which is fire. Don't forget, I said business interruption is under fire,
Mm-hmm.
okay? Or maybe anything that is classified under fire. It could be earthquake, it could be tornado, it could be flood, it could be fire in its real sense.
Mm.
Now, like I said, I have a club. I have a nightclub, and the rains are here now, right? And
Mm-hmm.
it rained heavily. The wind blew, removed my iron sheet. Part of my fence collapsed. And Lagos State, they are very, very meticulous with all these things these days. You are doing renovation yourself, they don't want anybody in that house. Now you cannot run your business. But when you took the fire policy, there is the add-on of business interruption. At the point of taking up this policy, if you request for business interruption, there would have been some questions they would have asked you, like what exactly do you do? Like how much do you make? You understand all those things. That is for them not only to be able to calculate premium, because some of us, what comes to your mind is when they ask you how much do you make, instead of you to say 20 million, but because you don't want to pay the exact premium, you will tell them it's 7.5. It is based on that 7.5, your loss will be calculated at the point where you will need insurance to come through for you. Okay? So I can't open my club because my club is under renovation. We are putting the fence back. We are putting the roofing sheets back and all these things. I'm supposed to be making money. I'm supposed to be selling my booze, but people are not coming to my club. That means I've lost money. Insurance comes into play. Then you are compensated for whatever loss you should have made within that period, while insurance too is also repairing your building.
That is
That's it.
amazing. Now, I know I have to let everyone go, but I just want you to help us with one more answer. Um, there was a time, I know it's a bit different, but I would just like to hear from you. There was a time when there was no point getting insurance because you finish getting the insurance and you never see when you raise claims were not getting honored. People were just, there was no point and people lost faith in insurance. What is
Okay.
different now that should make us trust it?
Okay. The first thing I will always say is that avoid. I know someone who is offering me a cheaper premium. You can always get it cheaper, right? Then go for quality, not quantity. Now, what has what is making the industry different? Regulations, sanctions. And aside that, ICO has been in business close to 70 years now. And we wouldn't be in business now if we've not been living up to our words. Uh, um, we pay claims. We pride ourselves in paying claims. The records are there for everyone to see. And people might wonder, they will not pay claims, or they just collect. That's why we have the pool of risk, pool of funds. We have the pool where, okay, everybody contributes money. Insurance is not new, if you look at it.
Mm-hmm.
Our parents were doing insurance from way back, where we go for family meetings and they say, oh, the money from the family of XYZ, they put it in the post. Now, the daughter of Mrs. Teni wants to get married. Oh, yeah, how much are we giving her? 250 naira. That has been insurance low key, having your back when you need it. Okay. So please put your mind at rest. We have credible insurance companies out there who are not after the money, but after the what's it called? The quality of also upholding the name and the dignity of the industry. We
Hmm.
have a few ones, ICO Insurance PLC and the rest, that you can actually patronize. And we'll be happy to have you all on board. Thank you very much.
Thank you so much, ma'am. Thank you. So could we have a way to reach you? Maybe you could put it in the comments, and so that people can reach out if they have any needs. I know Madam Josephine wants to talk to somebody, so please let's just put the comments. Perpetua, you could put comments, the way people could reach you in the chat, and also send it to me, please. So when we're sending out the recordings, we could include that as well. And then, of course, what is it that we do here in my space? Like most of us know, I'm a financial coach, and we have the Money Simplified course, which talks about a lot of things, everything around your finance, from budgeting to debt repayment to even your mindset around money to insurance, investment. All of this is covered in the course. And everything we've talked about today is in the course. So if you want to learn more, if you want to understand more, so that you're sure you're making the right decisions for your finances, please click on the link and get yours. Um the link will be up shortly. Please click on the link and get the course for yourself now. Thank you all so much for joining us. Thank you so much, Perpetual and Toyosi, for the amazing time this evening. And sorry to the Arsenal fans, but I mean, you did get this far, so that's something. Thank you all so much, and do have a good evening.
Thank
Bye,
you very much,
everyone.
and
Thank
bye.
you.
Thank you.
Okay, thank you for having us. I'll share the number. I'm trying to
You
find
can
out the
send
number.
it to me, and I
Yeah,
would
I'll send
include
to
it when
you.
I send
Yes.
out the
Yeah,
recording. Yeah.
share.
Thank
Thank
you.
you. Thank you so much. Thank you, everyone.